Love your home, but your mortgage interest rate, not so much? If you bought a home in 2022 or 2023, you braved a seriously difficult housing market. And hey, you made it out on the other side as a homeowner, but you might have a mortgage interest rate that's a bit higher than you'd like. If you've been waiting around anxiously for when is the right time to refinance, that opportunity might be coming up around the corner. But it's going to depend on your situation and how the numbers work for you. My colleagues and I at NerdWallet spend all kinds of time making sense of this stuff. So today, let's talk about how to know when it's the right time to refinance. When you refinance, you're taking your original mortgage and replacing it with a completely new loan. And that means a lot of things about the loan are going to change. The interest rate is one of them. With a refi, you're pretty much always going to get a new interest rate. And if rates have dropped since you bought your home, that can be a huge benefit. You may change the term of your mortgage or how long you spend paying it back. The amount of your mortgage could potentially change if you do a cash out refinance, because that means that you're taking out a loan that's for more than you currently owe. Another thing that can change is who owns your mortgage. You do not have to go with your current servicer or with the lender who originally gave you your loan when you refi. And in fact, if you're looking to save money and get the lowest rate, it can be a big benefit to shop around and check out different refinance lenders. If you're contemplating refinancing, you're going to need to know your credit score plus 3 other key numbers. You need your credit score because even though you already own the home, you do still apply to refinance. You need to know your current interest rate down to the decimal. So just saying, oh, it's around 7% isn't going to cut it because even fractions of a percentage point can really add up. So if you're not sure of the exact interest rate, go ahead and look that up. You also want to know how much you still owe on your mortgage. And again, we don't want it to be an estimate. Don't say, oh, it's around $300,000. Find out the exact dollar amount. Last, and this one can be a little bit more ballpark, how long do you think you're going to stay in the home? Now, if it's your forever home, that's pretty easy to answer. But if you're thinking, oh, if we have kids, we want to upgrade, maybe move in a couple of years, try to actually put a timeline on that, even if it might feel a little bit far away right now. Why do you need to know all these numbers? Let's get into it. It's always a good idea to keep tabs on your credit score, but you definitely want to have a good handle on your credit and have some strong credit when you're applying for a refinance. Same as when you bought a home, having a stronger credit score can help you get a lower mortgage interest rate. Now, hopefully, because you've been steadily paying your mortgage all this time, that's helped build your credit. But on the other hand, maybe you've bought a car or maybe you've had to take out loans to do some home improvement. You've kind of got some debt going on. You might want to hold off and build your credit back up before you apply to refinance. Knowing your exact current interest rate will help you figure out whether the rate you could get today is worth the trouble of refinancing. Now, sometimes you'll see rules of thumb like, oh, if you can save 1% on your interest rate, then it's worth refinancing. But that's really general. You want to run the numbers exactly for you, and depending on your situation and how that turns out, you could potentially find that it's worth it even if you're only saving half of a percentage point off your interest rate. Last, you need to know how long you intend to stay in the house to figure out whether a refinance would save you money at all. Now, if you're refinancing to take cash out or for another reason, saving money might not be your goal. But if saving money is your goal, you definitely want to pay attention here. So because refinancing costs you money, even if you're saving money from getting that lower interest rate, you aren't considered to have broken even until the amount that you've saved on interest offsets the amount that you spent on closing costs. That's called your break-even point. So let's say you spent $10,000 on closing costs, and that's saving you $200 a month on your monthly payment. We can divide 10,000 by 200 to get 50, and that gives us 50 months, so a little over 4 years that you'd have to stay in the home before you reach the break-even point. See how it's more complicated than just, could you save 1%? That said, figuring out whether it's the right time for you to refinance is also pretty manageable. And if you find any of the math the least bit intimidating, just head to nerdwallet.com and use some of our calculators. Our refinance calculator, for example, makes it really easy to see how much you could save at different interest rates. And speaking of interest rates, besides doing everything you can to burnish your credit score so that you're a stellar applicant for a refi, the best thing that you can do to find a lower interest rate is to shop around and compare different refinance lenders. Head to lender websites to see what kind of sample refinance rates they're offering and hopefully personalize those rates so you get a better sense of what you might be quoted. If you can't do that and it's a lender you'd like to work with, maybe reach out to a loan officer to see if they can give you a better sense of what kind of refinance rate you could expect. I'm Kate Wood, and I write about mortgages and home buying for NerdWallet. Not sure where to start looking for a refi lender? Head to nerdwallet.com and check out our list of the best mortgage lenders for refinance.